Treasury markets just aren't doing much. Why, Rick?
Yeah, that's a great question, Jonathan. I mean, so, when you step back and think about, okay, where are we now? The Fed has already moved rates to zero. The Fed, at least this Fed, is not moving to negative interest rates. So you think about what is the protection you're getting from Treasuries. The only place that you really have protection and where you really think about it is out the yield curve, 7 years on out, where you're seeing some movement. And listen, when you get shock moves, the Treasury market, particularly the long end, tends to move. But you're right. I think the way we think about how you take risk in today's market, you've got to run less risk, use more cash in a portfolio because, as you were talking about, gold, not sure gold is a hedge other than a significant increase again in the monetary base, creating some more upside momentum in gold. Treasuries are a pretty good hedge, but not great. And so you just got to run more cash. And quite frankly, you can use the volatility markets to manage your risk. We can talk about different parts of that, but it's a different paradigm than we're used to over the last 5 or 6 years when you had some interest rate to play with.
Well, Rick, let's talk about how you manage the volatility markets to manage risk at the moment. Given how it's priced going into year end, what do you suggest?
So, Jonathan, first of all, I don't know if you reported on it yesterday. The story yesterday is people were paying huge amounts of premium for upside in the equity market. I mean, that was yesterday's story. And so, part of what the concept of markets don't like uncertainty is 100% right. Investors actually like taking advantage when you get these sort of movements. Yesterday, it was a tremendous opportunity to sell upside convexity. So, when you get price movements like this, there are ways to actually sell. People are paying huge amounts of insurance for upside, and they're paying huge amounts of insurance for the really significant downside, the down 10 to 15%, where we would start to add risk. We would be happy to add risk if risk was down 15%. So you think about what's happening. You can sell that to buy some protection in the middle for local moves in the market. And it's been a pretty, days like today, it's fantastic. Now you can trade around.
Rick, let's talk about
two
days like today and how you trade around this. I asked Mohammed this question. I'll ask it of you. You and the team this morning, you learned of the president's situation. First and foremost for you, me, Mohammed, everyone watching this programme, our thoughts are with the president and the first lady, and we hope they're going to be totally fine. But from a market's perspective, how do you process news like that, Rick, this morning?
I mean, first thing is shocking. I mean, the first thing is, and like you say, we hope the president is fine, the first lady is fine. And it's just shocking. And the first thing that, quite frankly, I think about is you think about how people perceive the president, first lady that are probably the most protected people in the country, and think about vulnerability that others have. And I think part of why the markets react negatively is, gosh, you think about the perception that's out there, and the return to normalcy has to be slowed down as a result of that. So then you think about, where do you price that and how should the markets price? And I think rightly so, the markets are pricing it down a couple of percent. When the stock market is pricing it down about a couple of percent. If you saw dramatic fall off from here, then that's where I think you start to add again. Quite frankly, I was looking at, I haven't done much trading at all today because I think the markets are reacting probably appropriately to what the risk is, and obviously some news. Jonathan, when they finally chronicle 2020, this is one of the most bizarre experiences. And like I say, you've got to run your portfolio differently and try and generate return. I think one thing when people say, you just got to step back and not do anything, I'm not sure that's the right option either. There are some opportunities to take advantage of. You just got to be deliberate and pragmatic about how you do it.
Well, Rick, unfortunately or fortunately for you, if you want to get busy in this market right now, there's still 3 months left to 2020. It's certainly not over. Rick, from your perspective, how does the fiscal piece fit into this? Because I think that's the process many people are going through this morning. OK, here's the House situation. They jump deep into the realm of speculation. What does it mean to fiscal? Can they negotiate? Is it an incentive to get a deal? A disincentive to get a deal? Can they even talk to each other? Your thoughts on that, Rick?
That's too hard a question, Jonathan. That's the first thing we started to think about today. I mean, listen, we think the odds today of getting a fiscal deal done before the election are going to be hard. And it's going to be, I think that has turned to a much more difficult paradigm. And I don't think this news does anything to make it even a bit more difficult. It's hard to say, quite frankly, though, whether there is all of a sudden some inspiration and whether this number today will inspire the need for, there has to be more fiscal stimulus. The markets are expecting it. And it's a question of whether it comes pre-election or after election. But the economy needs more. I mean, the jobs, we could talk about the incredible improvement in employment over the last few months. That being said, there's a lot more to go. I mean, we're still talking about 8-ish% unemployment rate. We need more fiscal stimulus. And the Fed, it doesn't have a lot more they can do at this point, and their tools are blunt. It has to come through fiscal, and the system can absorb a bit more debt to get that done.
Well, Rick, that was my final question for you. The Fed's communicating what they'll do if things get better. Nothing. Have you got any clarity on what they do if things get worse?
So, I mean, listen, I don't think, there's been a bunch of people talking about negative, could you go to negative interest rates? I've said this for a long time. I don't think the Fed's going to negative interest rates. Could you buy more assets? And I think that's the direction they'll go down. I mean, forward guidance has been very clear. They've laid out they're not going to move interest rates till 2023, maybe longer than that. But asset purchases, I mean, this is a tool the Fed has. And by the way, that tool can be significantly bigger. And when people say they're out of tools, it's not true. And they could buy assets. And by the way, they've shown the flexibility around the myriad of assets they could buy, from credit to top parts of the capital stack in the securitized market. I mean, the Fed has been pretty flexible, but that's where they're going to go. And yeah, they have a lot more they can do at this point.